find your zone every day. Find your zone every day.
She didn't have to cut me off. Think I like it never happened to know we were nothing. I don't even need your love. You treat me like a stranger and I feel so loved. No, you didn't have to stoop so low. Have your friends collect your records and then change your number. I guess that I don't need that though. Now you're just somebody that I used to know. Now you're just somebody that I used to know. Now you're just somebody that I used to know.
Woo! What is going on, you guys? It is the emergency crypto bank run stream. What is up, man? I didn't have time to change the thumbnail, but USDC is repegged. That is right. The pegging season is here. But what is going on, you guys? Hit the like button, subscribe, hit the freaking notification bell, man. If you don't hit the notification bell, how are you going to find out that I'm streaming, man? Sometimes I just need to go on live just because I need to go on live. But damn, son. Well, today's video is going to be a special one. I'm going to do a reaction to a really good informational video on what's going on in the crypto banking sector. But as well as talking a little bit of conspiracy theory, as well as like to kind of reassure you guys, this run did not start because of crypto. This run started because of the Federal Reserve and then the banks as well. And there's starting to be a bit of a loss of confidence in the sector and stuff. So obviously, you guys know, you guys are in this, you guys are in crypto and stuff. You know that almost all banking is fractional reserve. So at most, a bank will have somewhere between 5 to 10% of users' deposits. So if there's more than that, if that ends up happening, then what ends up happening is that they have to start selling their assets in order to bring that money into fruition, in order to give people their money back, or bank wire transfer it to some other bank, basically. And this can cause a lot of problems. If you guys will do me a big favor, you guys, go retweet this tweet right here, man. Let's get everyone in here, man. That's right. And if you ain't following me on Twitter, man, shame on you. That's haram. That is haram, sir. W-Hex, baby. W-Hex, man. We'll get into the reaction vid in 1 minute, man. I can't start the stream off without talking about Hex, man. Yo. I'm not saying I'm always right, but damn, bro. Man, it's DCC season out here, man. I'm not missing much, man. I ain't missing much. Sheesh, man. That move going 25% Ethereum, 75% Hex. Chef's kiss. We're at 8.2 cents on the Hex right now. I think the last stream, we had touched 7.3 at the top. It came down to about 6.2 when the stream ended, and now we're up 2 more cents. Man, A week ago, we were at 5 cents. Now we're at 3 cents. A month ago, man, you guys, dude, it's been a nice 3 months for the Hexicans. I'll tell you that so right there, man. We bought the bottom here on the channel, and I bought heavy at 1.9 cents, and everyone else, hey, I hope you DCA'd under 2 cents or 3 cents. Like I said, man, you'd be up 2.5 times if you had DCA'd at 3 cents. If you bought at 2 cents, man, you're up a whopping 4x. That's pretty nice, man. Shout to Danny Boy. My portfolio is majority in Hex. I'm up 401% in 3 months. Damn, son. Yeah. That's beautiful, man. Hey, man, no problem, man. Crypto GRFX. Hey, shout out to you, man. DC, you planted the Hex seed in my head. Thank you, man. I don't just only talk about Hex, but I am Hex Jesus, man. And obviously, like, I think that was a screaming deal. That's why I was talking about that one versus Hedron. But right, but one little, if you want an alpha drop, I gotta create some little little drop and stuff for that. But basically, I think Hedron's sitting at a really good discount right now. I mean, Hex is at 8 cents, and it's still at 20 right now. So if I just take a quick look right now at the Hex price, right now, Hex currently is at 8.2 cents right now, which is incredible, right? But if we go to Hedron right now, we're at 22. So if you are making some Hex purchases and stuff, I would probably at least do 25% of your purchases in some Hedron. I think right now Hedron is fucking so undervalued. It's insane, you guys. Like, insane, dudes. So that I'm giving you guys this is the alpha right here, man. This is some alpha right here. And then it doesn't matter if it drops down to 18 or 19 or whatever. It's held up pretty. Last time Hex dropped from its 7 cents down to, I think it touched 5 cents for a second. This only dropped to about as low, if I'm looking at the chart correctly. Yeah, it dropped to as low as about 18. So it didn't drop that much relatively compared to what Hex pumped and dumped there and stuff like that. So Hedron's finding a good little place right here. I've been accumulating it as well in this range right here between 18 to 21. If you don't have any, you can basically scoop up a billion Hedron for $2,100 right now. And shout out to our boys. His Oath token's up another 30%. Beautiful. I love it. But I really don't see Hex having any resistance. I really don't see Hex having any resistance until we hit them on maybe like 10 to 12 cents. So looking pretty good, man. Just remember, hey, if you're up a little bit, hey, wouldn't be not a terrible place to put a little bit of profit into Hedron, but Hex is doing beautiful right now. I think this whole situation with USDC and stuff has really shaken up a lot of people in the space, and kind of got a lot of guys in the DeFi space to go, fuck, what am I doing, dudes? Like, and started to allocate capital. I mean, what me and Charlie have been saying about the crypto space for a while now is, it is a great. There's this year, Bitcoin, and I'm using Bitcoin as a bellwether for the whole system. Bitcoin's going to hit somewhere between $38,000 to $42,000 to $52,000 this year. So we're still looking at a really at least a 2x in BTC and Ethereum from these prices. And that, what do you think that'll do to altcoin prices? If you're not in the cryptocurrency space, man, I'm sorry, man, but welcome to poverty if you're not in crypto. But on my last stream, this was before the Fed announced. I hinted a little bit that the Fed might announce something during the break, and I guess they did. They are doing essentially they've done a really good they've done essentially the banking system solid and stuff, and created a 1-year sort of loan program for banks. So if a bank is having withdrawal problems, what they do is then deposit bonds that they have at the bank. And even if they're underwater, as long as the banks are like mortgage-backed securities or something like that, they can deposit these banks. They will get 100% of what the bonds are worth, not the interest, obviously. And they can use that to give depositors back their money and stuff. So this is actually both a good and a bad thing in the economic system, because this will make banks be able to do more retarded things in the market. So this is personally, the Fed has set up a lot of small to medium-sized banks to fail, because now you've allowed these banks more leeway to them to gamble in the system. But for us in the capital class who are in equities, equities and in stocks, and equities and cryptos, We gain from them being degenerate assholes. Let me say it again. If these guys are speculating and they're being stupid with money and reckless with capital, hey, we'll be there to pick up the money that they end up dropping on the floor, man. I mean, like, I'm just telling you, man, it's nice to be a hexagon. It's nice to be in the crypto space. The average altcoin's up to 2x right now. Ethereum and Bitcoin are basically up 50% to 40% from all-time lows. The average altcoin's up 2x right now. Hex is up almost 5x from the all-time low. We're sitting nice right now, man. We are sitting nice. My family finally thinks I'm a genius. Hit a like button for Carlos, man. Oh my god, that's hilarious, man. Let's see. DCC, now that USDC has repegged to $1, is it safe to continue to allocate my dry powder to? No, I would. For right now, I want to wait a week or so to wait to see how things I want to see what really happens in the market. I think right now it's I'd rather whatever dry powder I have, I'd rather it could go up and down. I mean, throw it into Ethereum if you're a little afraid right now, but that's where I'm throwing my dry powder in until I really see everything within a week or two. Once things kind of calm down in the markets and stuff with Tether and USDC and all this crap with stable coins, and then this whole banking thing's a little behind us, then I'll go back to using some USDC. But this is what I'm talking about. A lot of people are starting to put their trying to figure out shoot, I mean, what the hell? I might as well be holding Bitcoin and Ethereum at least, because I mean, I don't want to get caught holding something that that they don't have all their stuff backed up, basically. So now this is an important question, and I'll answer it throughout the video as well. Do you think we're going to be pulling back tomorrow? It's possible, but what's going on right now is that a lot of banks. I mean, a lot. We shout out to Rollo Tomasi and stuff, or even Rollo's having a little trouble with Coinbase with his account and stuff, because basically Signature Bank and a bunch of these other institutions are having trouble. Are basically closed down, and other banks are having trouble with funds and stuff because people are liquidating capital, trying to exit the space and stuff. So some people can't literally cash out into cash right now. So it's kind of become a crypto versus it's becoming a crypto world again, man, which is beautiful, man. Yeah, Hedron is my stable coin. That's not terrible. Honestly, hey, it's not terrible. That's not a terrible stable coin. I'm just telling you that, man. But that's the way I would play it. And shout out to Funny Jim, man. When you come into Vegas, man, I'd love to have a stream with you, man. This is one of my OG buddies right here. This is a good dude. Go follow Funny Jim. Great guy. But if you guys would do me a big favor, would you please go retweet and like the where'd it go? Oh, there you go. Yeah, go on my Twitter, retweet this out so more people can check this out. And then I'm gonna start reacting to a video by his name is Joe Blogs and stuff. This guy just came across my viewpoint maybe a month or two ago. He has some decent videos on a lot of multiple subjects, but he's been one guy that's been able to cover this whole bank run sector very well. So I want to give him a shout out. And I first time ever going to react to his video on stream and stuff. So yeah, man, pretty cool, man. So with that, you guys, I will be now sharing the screen and stuff, and then we'll start reacting to this video. There's a lot of great information in the video, and I'll be pausing it throughout the stream and stuff on certain points. There is one or two things I think I don't agree with him 1,000%, but like everything, we all have different opinions on stuff. But he gives great information, so give him a follow, man. And one last thing, how was the club with the boys? Yeah, Las Vegas was fun. We went out with Fresh and Fit, and we were out there with the Rumble team. They were out there for the Dana White Slap Fest and stuff. And yeah, we were hanging out, schmoozing with everybody. And yeah, we went to the club with all of them and stuff. Had a blast, man. It was really fun. We're making moves out here in the background, you guys. I can't say everything, man, but we're making some money moves in the back. So, without further ado, let's go.
After the collapse of Silicon Valley Bank on Friday, another bank just shut down. Regulators today abruptly closed Signature Bank. It has offices throughout New York and Connecticut.
Citing systemic risk, regulators shut down Signature Bank Sunday. The company told us no comment. The New York-based full-service commercial bank has 40 private client offices.
This is a byproduct of what we saw with Silicon Valley Bank. Uninsured depositors at any bank could start stampeding to their bank to take money out.
The Wall Street Journal reported that Signature was reeling from a bet on crypto banking. Earlier Sunday, Treasury Secretary Janet Yellen addressed the FDIC seizing control of California-based Silicon Valley Bank on Friday. It's the second largest bank collapse in U.S. history and is already affecting tech businesses it financed, including Roblox, Etsy, and Roku.
No, not Roblox. No. How am I gonna? So oh my God. So Silicon Valley Bank. For you guys who haven't seen my last stream, basically Silicon Valley Bank pretty much banks half of the startups in Silicon Valley. Literally, it is like it's insane how many companies are almost forced by their VCs to bank at this bank right here. This also, we'll talk a little bit about the stock market, but there's also another reason why, there's a lot of industry insiders that were pretty much buying Silicon Valley Bank because they knew with all this zero interest rate and all the money that was flowing around, this is a way a lot of people in the know were basically buying this stock up in order to make a lot of money and stuff. The same thing with Signature Bank too. Signature Bank did extremely well in the equities market. I mean, it had crypto-like gains, but I want to start this off. The Silicon Valley Bank, even though it has a couple of crypto companies maybe that bank with Silicon Valley Bank, most of it was tech companies from San Francisco. Okay, and the reason, and I want to reiterate again why the bank ended up having a huge problem. Okay, two things. Three things really. One was basically the interest rates had increased so dramatically. We basically went up 400 basis points. Oof. And this caused a lot of the bonds that they hold, and the bonds, every single company every single bank in the United States holds, to be in huge losses. And these are mostly like mortgage-backed securities and so, okay? And Silicon Valley specifically was holding mostly 10-year bonds and stuff for mortgage-backed securities, and they were earning like 1.5%, which is pretty shitty for the most part. But now, because of the increases, you can literally just go buy a risk-free U.S. bond and earn 2.4% interest. So it was kind of a very stupid move, and they were betting that we were going to stay at 0% interest for another fucking 5 to 10 years. So really dumb. But and this is crazy sort of thing with Silicon Valley Bank as well, is that 9 months ago, like in February of 2022, their top security analysts and stuff, basically the person that tells them like we shouldn't be allocating funds like this and this and this, they quit, and they didn't have anybody working in the bank in terms of making sure the bank was safe of how they were distributing their funds for 9 months. So for 9 months, they had nobody for basically all of 2022, when the interest rates were increasing, there was nobody at the bank at all. And then on top of that, when they finally got somebody back in the bank and stuff like that, what ended up happening is that pretty insane. From there, how can I say this? This is pretty insane to say. Basically, the top brass, days before the bank went down, they started giving themselves bonuses and stuff, and started exiting the company. And an hours before they kind of closed up shop and stuff, they pretty much gave almost all their employees money and stuff and kind of closed out. You saw the same sort of thing with Celsius and a couple other players that did this. So they knew they had known for about a couple months that they were pretty much going to go underwater basically. So. This was mostly a misallocation of funds from Silicon Valley Bank, but because Silicon Valley Bank went down, it caused problems in other banks because the whole tech sector had been put under pressure because of Jerome Powell's decisions to increase the interest rates so much in order to tame inflation. And a lot of job destruction has happened in the Silicon Valley space. And, we've had a mass amount of layoffs because of Twitter and other players as well, from Amazon, Facebook. Any major person in the tech space has been laying people off. So pretty insane, right? So don't let any video or anything convince you that this was literally a crypto problem. It was not. This was a Silicon Valley Fed problem, traditional space bank problem. Now, because of this and the crypto space kind of doing bad for a long time, you had a lot of banks who banked crypto companies under pressure, and then this increased pressure with Silicon Valley Bank going down caused more of the smaller players to withdraw money and stuff like that. It's kind of crazy. Silicon Valley Bank is the second largest bank failure in American history. Signature Bank is the third largest bank failure in the United States history. So damn, pretty insane. So, but Hex Price doesn't care, right? So we were in great assets, and the feds come to the rescue basically, and this is going to be a stream that comes out later on Fresh and Fit's channel. So we did a private call with the guys on Fresh CEO's channel, Fresh, just a couple hours ago, and what we told them in there was it should be out in, I think, in a day or two if you guys want to check it out on YouTube. But basically, we said that this was a way for like the Federal Reserve, because we know there's going to be a central bank digital currency here in the United States in 2025, 2026. So to me, this seems what the Federal Reserve is kind of planning with this in a way is giving a lot of the smaller banks the firepower in order to fuck themselves over, and then from there basically to centralize more of the banking sector. So right now, what's going on is that the major four banks and the Federal Reserve are pretty much trying to cause the all medium and small banks to fail in order for them to kind of centralize power, as well as seems like a concentrated attack against crypto banking, because we just had the top 3 crypto banks in the entire world basically go down, which was Signature Bank. We had Signature Bank go down. We had Silvergate Bank basically go down, and we had First Republic go down as well, which is a big bank down there in Puerto Rico. So interesting, basically. Like we just had an attack on the entire infrastructure for banking for crypto magically, and I don't think I think that's a consolidation. I think JP Morgan gained a lot from this right now, because now JP Morgan is the largest crypto bank in the United States now.
Didn't have to cut me off. Like you never happened, that we were nothing. I don't even need your love, but you treat me like a stranger, and I feel so low. So low. Got it back to change your number. I said I need that gold. Now you're just a body that I used to know. Now you're just a body that I used to know. Now you're just a body that I used to know.
So with that, you guys, keep that in mind. Keep that in the back of your head as you listen to this video. There's great information on the history of this bank and stuff and everything like that. So I want you guys to understand everything that's going on. But there's a lot of moving pieces, and you wouldn't know this stuff if you weren't so deep in the crypto space. But we also have to kind of stretch ourselves to learn a little bit about equities. Okay?
It sparked alarm about reverberations amid rising interest rates.
I've been working all weekend with our banking regulators to design appropriate.
Now, I know I just, God damn it, man. Like, this should not be the lady running or running. Oh my God. Anyway, I just let it go. But man, this lady, dude, is just a lot sometimes.
Policies to address this situation.
Hi, welcome back to Joe Blogs. In today's video, I want to talk about the failure of a third bank in the USA in the space of 5 days. And you may be thinking, I've never heard of Signature Bank. Who cares? It's irrelevant. But this is actually the third largest bank failure in US history. In a recent video, I talked about Silicon Valley Bank being the second largest. We've now had the third largest in the space of 1 week. So what is going on in US banking? The failure of one bank could be put down to specific circumstances. The failure of 2 banks could be a coincidence. But the failure of 3 banks in less than 7 days tells us that there is something concerning happening in the world of finance right now. So in today's video, I'll give you more details on Signature Bank. We'll look at exactly what caused the failure. We'll talk about cryptocurrency, because Signature Bank did have a relationship with crypto. However, it was relatively small in the context of the bank. We'll look at the details of the FDIC takeover and bailout that's been announced. We'll have a look at what's been happening with Signature Bank's share price and market capitalization, because the company was listed on NASDAQ. We'll talk about the ongoing risk of contagion and the likelihood of more bank runs happening in the USA over the course of the next week or so. And then finally today, I'll wrap up with my summary. So what I think is likely to happen in the banking sector over the course of the next few weeks and months, and what the implications of this are for the global economy. Signature Bank was founded in 2001 by Joseph DePaulo, who'd formerly worked at Republic National Bank of New York before it was purchased by HSBC. 6 branches were opened simultaneously across the New York area, with the goal of catering to wealthy clients and middle market business managers with assets worth more than $250,000, which is an interesting figure, as obviously that's the amount that's guaranteed under the FDIC rules. Originally, the bank was established as a subsidiary of Bank Hapoalim of Israel, which originally provided around $60 million.
Damn it. I knew the Israelis going to be in here somewhere, man.
That's the amount that's guaranteed under the FDIC rules. Originally, the bank was established as a subsidiary of Bank Hapoalim of Israel, which originally provided around $60 million in capital to fund the bank. Unlike a lot of traditional banks, the business model was not focused on providing loans to clients, but rather used the deposits it was taking from its customers to invest into low-risk assets such as bonds. In its first few years, the bank grew rapidly, and in March 2004 completed an IPO on NASDAQ. The ethos of the bank was to grow through word of mouth and personal relationships, and despite the branches not having any street signs and the company not embarking on any advertising, between 2004 and 2014, the company's stock price rose by more than 650%, which represented a return that was 10 times higher than the S&P 500. And
that's some crypto gains for you right there, man. So they definitely were doing some stuff in the background in order to get that kind of growth rate. I mean, he's about to say this in a minute, but basically this was the best for Signature. I mean, Signature Bank was, I think, the best performing stock for the bank stock in the last decade, as well as I also believe Silicon Valley Bank as well was like the second best performing as well.
And it became the single best performing financial institution. Interestingly, the second best performing financial institution over that period was Silicon Valley Bank. In 2017, Signature Bank expanded outside of the New York area for the first time, and in 2018 opened its first offices on the west coast of the USA in San Francisco. And this move...
You see how magic it is and stuff like that? It's just, it's so many coincidences with this thing, right? Like this bank stock goes bananas. It's going insane in New York and stuff like that. The other bank which is going insane in San Francisco. And then basically they start getting into trouble when this bank ends up going over to San Francisco, and then the other bank starts expanding as well and stuff. It's just really interesting. Like we were talking about the 2 fastest growing bank stocks of this last decade, basically both imploded and stuff. Interesting. It's almost planned, almost.
Coincided with the bank's decision to start servicing the cryptocurrency markets. Signature Bank attracted some of the biggest names in cryptocurrency, such as Coinbase, Circle, and Paxos. By the end of 2021, around 16% of all of the bank's assets came from the cryptocurrency sector. However, by February 2023, that figure had grown to around 30%. The move into cryptocurrency had a positive impact on the bank's share price, which increased from around $75 to a peak of $375 in October 2022. However, as I'm sure you'll be perfectly aware, in November 2022, FTX, the second largest cryptocurrency exchange in the world, failed when it was revealed that founder Sam Bankman-Fried had been using customer deposits to fund losses, investments, and his hedge fund, Alameda Research. And as a direct result of the failure of FTX, the crypto markets went into freefall, and this was really bad news for Signature Bank.
Well, that's not completely true in terms of like we'd already been in sort of free fall already. Obviously, we had. I mean, basically, we all know what really went down. It was pretty much Three Arrows Capital going down, and then as soon as Three Arrows Capital went down, we had Luna, and then after that, we had FTX go down. So we had already been going down. So, but still, it's that wasn't a great sort of thing. I mean, 2022 was a very rough year for crypto. But shout out to everyone that's in the chat right now, man, because we're out here, bros. We've made it past some of the roughest times. We're in gains right now, and the rest of the market's sad and crying. And then we're over here with counting our gains, man, as should be, man. We suffered for it. Now we get to reap the rewards.
So why has Signature Bank failed? Well, you may be sitting there thinking, well, you've just told me the answer. You mentioned crypto, everything relating to crypto is in freefall, so therefore the failure of Signature is related to crypto and has no impact on the rest of the financial world. But if we look at the facts of this case, on Friday...
Yeah, I gotta stop the stream for a minute, man. Dude, I love this, man. So much money in my wallet now. I just purchased a ledger. Such a nice problem to have. Shout out to my boys, baby. Sheesh. We're one of the few channels that didn't disappear, man. Like and subscribe, hit the notification bell, man, because they're out here kind of shadow banning my channel a little bit. But that's why I said follow me on all the social medias. I mean, go look in the bio below and stuff. And I literally have I've got my Instagram, Twitter, and everything else there to contact me. Just if you're paying attention, you're gonna be able to see us, and then you're gonna be able to gain this info, man.
Friday, the 10th of March, Signature Bank had total assets of $118 billion. And out of those assets, crypto-related deposits equated to 16.5. So that's around 14% of the total assets of the bank. And in fact, when you look at the history of Signature Bank and look at its business relationships, it's actually stronger in the world of law and finance. Signature Bank is known predominantly in New York for providing banking services to law firms and real estate companies and for catering to wealthy families.
Now, this is a really interesting sort of fact that 14% of the bank deposits were crypto. Now, that's not most of its deposits, but it's a really significant amount. But one of the reasons I also believe they went after Signature Bank a little bit as well, and may have you never know if they force banks to do really stupid stuff like hold certain bonds or pressure certain banks to do things. But imagine that this was basically one of the main payment gateways in the background that a lot of crypto companies were using, and now it's gone. Interesting that we just had all these crypto banks just magically go down. Now that crypto's bottomed out and is doing okay, you would think that there wouldn't be like bank runs or anything like that. But it's just interesting how like these banks would position themselves, and these are all banks. These are all, now I gotta say allegedly here, but these are all banks that are on the NASDAQ, and they all have a board of directors. And I wouldn't be shocked that allegedly, possibly, maybe things were told to do certain things that could be torpedoed later on. I don't know. Hey, I'm just a man with a tinfoil hat on. But hey, what the hell do I know, right?
Families in the area. In fact, its most famous client up until the Capitol Hill riots was Donald Trump's company, the Trump Organization. So with only 14% of its assets being related to crypto, you couldn't really describe Signature Bank as a crypto bank. However, the problem that Signature Bank had is that it had a number of large cryptocurrency corporate clients. However, the main problem that Signature Bank had relating to its crypto clients is that it had created a fast payment system called Signet, which was the only other alternative option for cryptocurrency clients who wanted to make fast payments alongside Silvergate's SEN, Silvergate Exchange Network. Now, as you may have seen in one of my previous postings, on the 3rd of March, Silvergate announced that it was closing its SEN network as a result of liquidity problems within the bank. And that raised alarm bells amongst all of the cryptocurrency community. They became aware that Silvergate was running out of cash, and so there was a run on that bank. And then all of the cryptocurrency businesses looked around at their other banking relationships. They looked at Signature and decided that they needed to remove all of their money from Signature before it got itself into the same situation that Silvergate was in. So as a direct result of this action, there was a run on the bank. All of these corporates wanted to move hundreds of millions of dollars that they had on deposit with Signature. And when confidence starts to fall in any financial institution, it's very difficult to be able to stop that momentum. Now, in an attempt to calm its customers, on the 9th of March, which is the day after Silvergate announced that it was going into liquidation, Signature Bank issued a press release reiterating its strong financial position and limited digital asset-related deposit balances in the wake of
Man, if you're really in trouble as a bank, man, and you said, no, we're perfectly fine. You know what I would do if you're going to be fucked right now, he's like, withdraw your money, motherfuckers. I double dare you. Do it. Just do it. I don't care. Just come out I don't know, man. It's pretty hilarious and stuff. But basically, I mean, this has become a joking in the space and stuff. He's like, funds are safe, steady lads and stuff. I mean, it's just like, oh boy, bad times coming.
industry developments. This statement said that Signature Bank was a proven, stable commercial banking business with in excess of $100 billion in well-diversified assets across 9 national business lines and nearly 130 commercial banking teams spanning its metropolitan New York area and West Coast footprint. It said the bank had a diversified deposit mix with more than 80% of deposits coming from middle market businesses such as law firms, accounting practices, healthcare companies, manufacturing companies, and real estate management firms. It had a high level of capital, as evidenced by a common equity tier 1 risk-based capital ratio of 10.42%, which is well in excess of regulatory requirements as at the end of 2022. It also had investment-grade long and short-term credit ratings, which were recently affirmed by Fitch Ratings, Kroll Bond Rating Agency, and Moody's Investor Services. In terms of its liquidity, on March the 8th, the bank held cash balances of around $4.5 billion, borrowing balances of around $6.6 billion, with additional capital of around 20.
So we'll look right there, right? So cash held on the balance sheet approximately $4.5 billion. Then they just said this bank had effectively $114 billion in assets, right? So basically, they basically only, for all that money they had, they only could, if there was a bank run, they only had $4.5 billion to give people before they were in trouble and they had to start selling assets. Now, I get why they do, they do all this kind of dumb stuff but it's kind of insane that they weren't at least. It's crazy to me that they're not at least doing like an 80-20 principle. Like they should have had like $22 billion of cash on hand and $80 billion of assets,
$29 billion, Kroll Bond Rating Agency, and Moody's Investor Services. In terms of its liquidity, on March the 8th, the bank held cash balances of around $4.5 billion, borrowing balances of around $6.6 billion, with additional capital of around $29 billion, marketable liquid securities of approximately $26.4 billion, deposit balances of $89 billion, which were up $576 million since the end of 2022. And these balances included the deliberate reduction in digital asset-related client deposits of almost $1.3 billion, resulting in a balance of $16.5 billion in digital asset-related client deposits. So that's basically crypto clients. Total loan balances were $71.8 billion, which represented a reduction of 16.5 of almost $1.3 billion, resulting in a balance of $16.5 billion in digital asset-related client deposits. So that's basically crypto clients. Total loan balances were $71.8 billion, which represented a reduction of around $2 billion since the end of 2022, as the bank executed its previously announced strategy to reduce loan balances in its larger business lines. The statement went on to say, "We want to make it clear again that Signature Bank is a well-diversified, full-service commercial bank with more than 2 decades of history and solid performance serving middle-market businesses. We have built a strong reputation serving commercial clients through 9 business lines and reached in excess of $100 billion in assets by continually executing our single point of contact relationship-based model where banking teams are capable of meeting all client needs." As a reminder, Signature Bank does not invest, does not trade, does not hold, does not custody, and does not lend against or make loans collateralized by digital assets. We've repeatedly communicated that our relationship in the...
All right, so with that right there, man, so you can't blame crypto for your misgivings. Now, though I will say one thing with that little statement they just did there, because crypto was going down, these $16 billion in assets held at the peak there, you probably end up having at least half of that pulled over the year, which shouldn't be a problem, because obviously as the prices go down, people need to bring in capital either because they're buying the dip, they need to pay payroll, and there's just capital, and then there has to be expenses in the businesses anyway, right? But the problem here is that Signature Bank wasn't the start of it. It was the other one, which is the Silicon Valley side. And because of that, it caused a lot of other people, a lot of players who were holding money in a lot of other banks started to pull money. So they ended up just having a really heavy month of withdrawals, and boom, caused problems. And then they had to start selling bonds that they were underwater on, and then realizing losses, and then that's what put them into trouble. So that's what was going on.
The digital asset space are limited to US dollar deposits only, and we remain fully committed on executing on our plan to deliberately reduce these deposits further. Since we opened our doors, we have been a deposit-first institution and have always been committed to our depositors' safety first and foremost. As shown by our current metrics, we intentionally maintain a high level of capital, strong liquidity profile, and solid earnings, which continues to differentiate us from our competitors, especially during challenging times.
Holding a lot of capital. So they had $4.5 billion in capital. We were talking about $114 billion in terms of like assets they had for customer money, right? So we're talking less than 5% cash on hand. What the fuck are you talking about right now? Bros, like they're like, we have plenty of cash on hand, you guys. Just tons of it, you guys. They're damn near, what are they, like damn near almost 3% to 4% cash on hand.
So when you look at Signature Bank in that context, logic should tell you that actually everything's fine. This bank is well capitalized. It's actually got relatively small exposure to the crypto markets. None of that exposure is actually speculative. They're not investing in crypto. They're not betting that Bitcoin's going to go above $50,000, for example. All they're doing is providing services to some corporates that work in the crypto industry. So when you look at all of the facts, that should give everybody confidence that this bank has long-term viability. However, as you saw at the start of the video, Signature Bank has failed. It's gone. And the basic reason for that is that its customers lost faith in the institution. When a bank run starts, nobody's reading press releases, looking at capital ratios and thinking about the long-term history of the bank. All they're thinking about is getting their money out of that bank as quickly as possible. And when you have a run, it's virtually impossible to stop it. And that's exactly what the management of Signature Bank have found. Even though they had all of these facts and figures that do make sense and logically tell you that there is no risk, nobody cared. Everybody wanted to take their money out. And because it's impossible for banks to be able to give everybody all of their cash simultaneously, because they've locked up all of that cash into longer term assets like bonds and loans, which are very difficult to realize. Or if you do realize them, you actually incur a huge loss and therefore is detrimental to the business. Because of those dynamics and the fact that customers wanted to remove their cash, the bank was failing and needed to be bailed out.
Now, one interesting little thing about how banks work is that they essentially have sort of like you know how in Hex there is a good what's it called, you can end stake or you can good accounting. They essentially have a good accounting in a way where basically they buy these bonds, and what they could do is this. So like, all right, so imagine you have all these bonds that are basically underwater because the interest rates are going up, right? And this is causing the price of your bonds to go down. So you have $100 million in bonds. I increased the interest rates by 4%, and now I'm down $25 million on my bonds if I sold them today. What a lot of banks can do is there's something called the hold to term, which is their good accounting. And what that means is basically that they are going to take those bonds and basically put them on the sidelines of the bank sheet basically, and all banks do this to some extent, right? So basically you can hold a lot of banks just hold like some bonds are just so fucked that they just put them there, but basically a lot of banks end up putting a lot of their kind of their shitty bonds in this category, and they just wait until they pay until the term limit's done and they get all their money back. So if I hold a 10-year bond that's down 50% on paper, what I can do is just hold it for 10 years and I'll get my capital back, and then I'll still get paid the dividends on it on a monthly or weekly basis, depending on the bond itself, right? Well, what a lot of these banks did is since a lot of these bonds were really, really, really bad, they put a extraordinary large amount of them in that good accounting feature. So what happened was when this started, when they had a bank run, once they put them in that section, they can't switch them back. It's a one-way street, right? Because they're getting a big tax saving there, and they're also saving their balance sheet for the equities market, right? So what happened is these banks also they used too much of this good accounting on their assets, so they didn't have access to the bonds. So what ended up happening is that they took huge losses, and they could have possibly realized a lot of these losses, but kind of like Ponzi'd it up, but they couldn't. So this is why. So a lot of these were like, it's kind of crazy. I saw a report just yesterday that, like, I mean, if we were to take into account the amount of losses these banks actually have, if without that good accounting feature, I think Bank of America had like what, I think they were down $106 billion in losses on these bonds they've purchased. It's freaking insane, actually. So you're not supposed. So these banks are not supposed. You're not supposed to be 80-20 split. Like 80% of your bonds should be in the good accounting. That it should be more like maybe 20%, or maybe some really the bad ones, so you don't look as bad. You put them into that side. But a lot of these banks, I only know of Silvergate doing this, as well as what's the other one? Was it Republic? I think it was Republic that did this a lot. I don't know the numbers just yet on Signature, but I do know that these other banks put a lot of their bonds on there just because they took such a fucking L on it that they had to wait. So it's just a crazy sort of thing where, I mean, and right now, because the Federal Reserve essentially had their emergency meeting this morning at 11:30 in the morning. They pretty much agreed to this 1 year loan give out, which is basically it's a bailout to print money and stuff like that. And it's a lot of these bonds. I wouldn't be surprised they put some sort of something in there so they can, the good accounting bonds, they could just grab those and put them into that loan program. So let's just say I'm down $25 million on my $100 million of bonds. I can then take my $75 million to the Fed. They'll take it from me for about a year or so. And then I can get I'll get $100 million and I can pay back my depositors and I'm scot-free. So this is going to, because there's this big ass, parachute right here. It's going to cause banks to do more retarded stuff. Insane.
On Sunday, the 12th of March, New York State Department of Financial Services issued a press release announcing that they had taken possession of Signature Bank in order to protect depositors, and that the Federal Deposit Insurance Corporation, FDIC, had been appointed as the receiver. At the same time, the US Department of Treasury announced that due to systemic risk, Signature Bank had been closed by the state and that all depositors of the institution would be made whole. They went on to say that shareholders and certain unsecured debt holders will not be protected and that the senior management of the bank had been removed. The statement says that any losses to the Deposit Insurance Fund to support unsecured depositors will be recovered by a special assessment on banks as required by law. It's subsequently been reported that the FDIC has established a bridge successor bank, so a new company, which will enable customers to access their funds from Monday the 13th of March, with all Signature Bank depositors and borrowers automatically becoming customers of the new bridge bank. Former Fifth Third Bancorp Chief Executive Greg Carmichael has been appointed as Chief Executive of the bridge bank. New York Governor Kathy Hochul said she hoped the U.S.
Now, this is interesting that they're using the bridge bank. This bridge bank may end up, because it's an arm of it's FDIC, but I mean basically it's also kind of a semi part of the Federal Reserve. Who knows? They might end up using, if more banks fail, this bridge bank might become so big that they may use this as another facilitator for the central bank digital currency. Who knows? I mean, it's a little early to know right now, but it's just like this bridge bank, it might end up becoming a thing. And I wouldn't be shocked one day that bridge bank goes to shit too one day and they call it London Bridge is burning. But there was kind of crazy. There was actually if I remember correctly, the only bid for any of these banks was from a Silvergate. I think a UK firm wanted to buy it basically because they had like 16% of customers in the UK, and then they wanted to protect their UK customers. But there may have been some sort of there may have been some geopolitical shit there why they didn't let them buy it and stuff. So it's interesting.
The new bridge bank. Former Fifth Third Bancorp Chief Executive Greg Carmichael has been appointed as Chief Executive of the bridge bank. New York Governor Kathy Hochul said she hoped the US government's actions on Sunday would provide increased confidence in the stability of our banking system. And many depositors at these banks are small businesses, including those driving the innovative economy. And their success is key to New York's robust economy. Regulatory filings show that around 90% of all of the bank's deposits, so around $80 billion, are uninsured under the FDIC scheme. Now, this chart shows the movement in the Signature Bank share price over the course of the last 5 years. And this shows that up until the end of 2020, the bank's share price moved around between a high point of around $150 per share and a low point of around $70. However, during the course of 2021, the bank's share price took off. And by January 2022, it was sitting at around $370, which valued the business at more than $44 billion. And the main reason for that rapid increase in the share price and the valuation of the business was because Signature Bank had developed its relationship with the cryptocurrency markets. It had launched its fast payment service, Signet. And as the cryptocurrency markets took off and everybody wanted to invest into anything crypto related, so did the share price for Signature. However, as I've talked about in other videos, in the world of cryptocurrency, what goes up must come down. And over the course of the last 12 months or so, as we've seen a number of cryptocurrency failures, the share price of Signature Bank has tanked. And prior to it being taken over by the FDIC, the share price was back down to around $70. Now, just to be entirely clear.
Now, I don't completely agree with his take here in terms of like this is the only reason why the bank stock shot up so much. Sure, during that time, crypto was pumping, so people were just buying anything that had anything like anything that was touching crypto at all. But whatever income they were generating wasn't enough to pump it up this much. If there was a pump off of the cryptocurrency space, we also got to remember 2021, 2022 was a great year for equities and stuff like that. So this was also pumping because the rest of the market was also really hyped up as well, right? And there was a lot of money printing that happened. We also got to remember one of the main reasons why some banks, especially if they're Signature Bank, is primarily focused on individuals with $250,000 and up and stuff. You'd be hard pressed, right? You got to imagine like there's something called the PPP loans. There's a lot of people who got these small business loans. The first loans people were able to get, I mean, they were just these non-repayment loans. It was free money from the government. That's what really caused inflation. Now, forget whatever you believe about like, oh my God, the COVID checks, whatever, like that's what caused the inflation. The COVID checks tops was $3,000 per person if they got them, right? That wasn't enough. No, there was tons of small businesses that got $100,000+ loans that didn't have to pay back to the government. Then there was these secondary loans that people don't even know much about, where they were able to get, I mean, up to $1 million. I mean, the Lakers tried to get it, and they gave the money back because people fucking found out about it and stuff. Go look it up. And so there's a lot of these small businesses who didn't have money, who were like their businesses were just floating around and stuff. They just qualified. They got all this free money and they deposited in banks. This is one of the reasons why some of these small banks went bananas with capital. So what ended up happening is that these banks had a glut of cash and they needed to put it somewhere. So they started putting it in bonds at the time. And that's basically what really happened here. So just a little FYI there.
Yeah, Signature Bank has now collapsed. So the shares are completely worthless. So anybody that was holding shares in Signature Bank prior to the announcement on the 12th of March have now lost all of their money. And the reason I wanted to show this is that you might be thinking that because the FDIC have come in and said that they will guarantee all depositors' funds, that there's actually no losers. Everybody is okay because it's all been bailed out by the government. However, anybody that's invested into Signature Bank and was holding shares at the time of its collapse have obviously lost all of their investments. And this company was valued at $44 billion just over a year ago. So that value has been completely wiped out. And as with the failure of any financial institution, there will be knock-on implications. But one of the biggest implications is the simple loss of confidence. When both the market and individuals see a financial institution collapsing, it raises concerns that other institutions may also follow suit. So people with money on deposit with smaller banks and financial institutions are starting to look at their portfolio and wondering whether or not they need to move money. And over the course of the last 5 years, we have seen an explosion in the number of financial institutions. Fintech has been one of the biggest growth areas in terms of venture capital. Lots and lots of new online businesses and financial institutions have popped up. They've been taking money off people left, right, and center. And all of those businesses are now facing the risk that all their customers will say, actually, I would like my money back and I'd like to put it with one of the big institutions because that's where I feel safest. So the investors of Signature Bank have lost all of their investment. But the risk here is that other investors in other financial institutions will also see the value of their investments falling and may also lose all of their cash. So what's the summary and conclusion today? Well, I wanted to post this video because it's rare to see a bank fail. It's very rare to see two banks fail within a matter of days. But it's extremely rare to report that 3 banks have failed in the USA in a matter of 5 days. And Silicon Valley Bank and Signature Bank are the second and third largest failures in US banking history. So the collapse of these two banks is meaningful. And I think what's causing the main concern is that these banks haven't failed because they got their lending strategies wrong. They lost a whole lot of money in certain.
I know what he's saying is really important, but I just got so distracted with these guys just pointing at these random things for no that there's no. I mentioned these actors were told like, "Yo, bro, just point at like you guys are talking something really engaging and stuff, and like you'll be the numbers guy, and this guy is like will be the CEO or some shit." But basically these are the two biggest bank collapses in the last like in U.S. history. Basically, Silicon Valley Bank being the second largest, with Washington Mutual being the first biggest, and then the third being the Signature Bank. It's interesting.
Are the second and third largest failures in US banking history. So the collapse of these two banks is meaningful. And I think what's causing the main concern is that these banks haven't failed because they got their lending strategies wrong. They lost a whole lot of money in certain markets, and therefore they only have themselves to blame. The reason that these banks have failed is because their customers tried to withdraw all of their money simultaneously, and it's impossible for banks to be able to meet all of those withdrawals. They both hit a liquidity crisis and therefore had to be bailed out. And the risk of being a victim of a bank run and therefore falling into a liquidity crisis hangs over the head of absolutely every financial institution in the world. Now, when you hear about a bank run, you think of those images from the 1930s with individuals queuing around the block to try to get their life savings out of that bank. But bank runs today are very different. What we're talking about today for Signature Bank and Silicon Valley Bank are corporate bank runs. These are large institutions that are looking to take large amounts of capital out of that bank by digital transfers. So for Signature Bank, it was companies like Coinbase and Paxos looking to remove their deposits. And it's reported that both of those institutions have around $250 million on deposit. So what Signature Bank was experiencing were large electronic deposit requests of hundreds of millions of dollars. So generally speaking, people aren't queuing around the block at these banks. What they're doing is going online and trying to transfer all of their funds.
I mean, we've said this before already. You're already using it like the dollar is already the dollar basically is already a cryptocurrency. You just haven't figured it out yet. If you think about it, right? It's like how often do you? I mean, outside of going to the strip club, you guys, right? Or whatever kind of or gambling and stuff in casinos and stuff. Most of your money is like you're zellying money to somebody else already. You know, you're logging into Chase. I'm gonna Zelle you some money here. I'll only pay that. Oh, thanks for getting dinner, bro. Here, I got you. And next time, oh yeah, for sure. You know, like money is digital. Other than the Federal Reserve, like this is the secret inflation. This is what a lot of people don't know. This is like besides the Federal Reserve, who actually can print money, create money out of thin air, and actually give the permission over here to the Treasury, who then the Treasury actually creates physical dollars in the real world. Most money is printed by actual banks. Your local bank. So when your bank gives you a $40,000 loan and stuff, they don't have that in cash on hand. They just say on the computer that you have $40,000 and now it shows up in your bank account. That's where money printing actually happens when money is debt. This is one of the first things Robert Kiyosaki taught. Money is debt, and the rich use debt, right? But it's the sort of thing where like when all this debt creation is happening and stuff, that's where the inflation's happening. It's all numbers on a sheet. It's all a zero. It's all zeros, you guys.
Funds at the same time. And of course, it has the same impact on the bank. If you don't have that amount of available capital, you can't allow those transfers to go through. Therefore, you have to close your systems, and therefore you're no longer operating as a bank, and you have to call in either the receivers or FDIC or institution to take over. So as we've discussed in this video, the press have labeled Signature Bank as a crypto bank. So you may have seen headlines saying crypto bank Signature has collapsed, and therefore thought, well, it doesn't really matter because the whole world of crypto is going down the pan anyway. But as we've seen from the data today, the majority of the assets and customers that Signature Bank had were not crypto related. So the run on the assets really relates to that 14% of their asset base that was exposed to the crypto markets. So this really shows you the risks that a bank is looking at, because if only 14% of its customers are demanding the withdrawal of its assets and the bank can't
All right, I'm disagreeing with this. It wasn't just because of the crypto side, because remember, Signature Bank didn't go down before Silicon Valley Bank. No, it was no. It was not the 14%. Now, sure, there was withdrawals from crypto companies, of course, right? But what it really was Silicon Valley. It was tech companies withdrawing capital from Signature Bank that caused the bank run first. And then everyone in the tech sector, which is crypto included, said, "Holy shit, let me start taking some capital out." This is like this is one thing I have to disagree with him right here. Even though they're pinning this on crypto here for this bank, it was because of tech companies withdrawing capital from every single bank they had bank accounts in. So, just an FYI here, you guys.
Meet that amount of withdrawals. That shows you the precarious nature of finance. So when you look at the big institutions, yes, they may have hundreds of billions of dollars of assets, but they only have a small fraction of that that's available for withdrawal at any one point. So if you start to get a build-up of customers wanting to move all of their deposits out of your bank, it can very quickly develop into a liquidity crisis. So the key question from today's video is this the start of a major financial collapse? Well, when you look at what happened back in 2008 when the global financial crisis struck, the first institution that got itself into difficulty was Bear Stearns in March of 2008. And that company was actually acquired by JP Morgan for a bargain basement price. And at the time, everybody thought that had solved the problem, that everything had gone away. But in September of that year, that's when everything started to collapse. We saw Lehman Brothers go down. We saw multiple institutions all around the world getting into financial difficulty and having to be bailed out. So there was a 6-month lag between the first bank getting itself into major problems and the situation developing into a full-blown crisis. So what's going to happen now? Are we going to see other institutions following suit? Well, I think the proof of the pudding will be what happens over the next 3 to 6 months. At the moment, we're reporting on 3 bank failures in the USA in the space of 5 days. If we start seeing more bank failures popping up in the USA and other countries over the course of the next few weeks, then that is raising a major red flag that we are on the verge of some form of financial disaster. The facts that we know right now are that interest rates have risen rapidly over the course of the last 12 months. And that means that a lot of the assets that banks have been investing into over the course of the last few years, when yields and interest rates were very low, are now out of the money. So banks really don't want to be forced to cash any of those assets in because that will crystallize large losses. In addition to that, over the course of the last 6 months, we've seen a slowdown in the global economy, and the outlook for the global economy is now far lower. And the third factor that materially raises the likelihood of some form of financial crisis is that there's been a huge drop in confidence. The reason that these 3 banks failed was because there were runs on their accounts. Customers wanted their money out because they believed that those institutions were at risk of failure. And that is contagious. That sort of thought process will spread very quickly all around the globe. And as soon as any customers of any financial institutions hear that there's a risk of that institution going bust, they will want to take their money out very quickly. That then causes another run and potentially another failure. So when you look at all of the ingredients, there is a very real possibility that we are now sitting on the verge of another global financial crisis. So hopefully you've enjoyed the content of.
And that's the video, you guys. Interesting, right? So, no, I think he was pretty on the money though. Like, I had a comment right here, man, where it says like, Miguel, do you think we already have contagion? Let me see if I can put it up for the. All right here, Rect Pleb. Oh, what a great name, DCC. Do you think do you think Silicon Valley Bank contagion will spread to other banks? It already has already. So hopefully they can nip this in the bud. The Fed has released that program. Hopefully that's enough to stop it down. But if it isn't, the Fed's going to have to start stepping in. Now, this is the interesting thing, right? So let me see if I can share you something about the Federal Reserve real quick. So, okay. So if you look right here, this is the Federal Open Market Committee. So this is basically the Federal Reserve. The next meeting for the Federal Reserve is March 21st to the 22nd. They had an emergency meeting this morning at 11:30 in the morning. They did not raise interest rates or anything like that, but it'll be really interesting to see if they keep increasing interest rates because remember what I said, that 5.25 to 5.5% to the federal fund rate is when things can really start breaking. So we are only like literally 50 basis points away from starting to get in some deep shit in the market stuff because you can start getting small cities going bust and stuff because they can't pay the loans on some of these loans they've taken or bonds and stuff. And on top of that, like you gotta imagine a lot of these municipalities probably taking some bad deals and stuff. You know, they always like one of the top things. Like there's something called what is the name? Was it Calipers? It's basically the biggest retirement fund here in California and stuff for doctors, lawyers. Doctors, lawyers. It's a lot of government people, some cops, firemen, and stuff like that. Like they always dump the worst investments and the worst investment advice on these retirement funds. It's really sad. I mean, they basically see like, oh, there's all this normie money here and stuff like, let's steal this money. Let's find a way to steal this money with products we can sell them and stuff. So it is insane just the amount of like how many people's 401ks and how many people's retirement accounts are completely belly up and people don't even know that yet. Dude, not great. Now, if they continue with the increase, holy shit! But this is what the Fed wanted. The Federal Reserve. If you go on my channel, go on my YouTube channel, go look under the live tab. I have all these Federal Reserve videos and stuff. I've got 3 of them up. Listen to the most recent one. What Jerome Powell and the people at the Board of Governors want. They want to destroy jobs in America and hurt the capital class, which is people who hold stocks and cryptos, in order for us to lose the wealth effect, so we stop spending money. So because they've already printed money and they got to spend the money, right? I've said this before. I've said this a lot of times on my channel. The federal government does not need to tax us. The reason they tax us is because they print money. The federal government prints money. They don't need to tax us. The reason they tax us is because they print money. They spend it. They're like, oh fuck, we have to take money away from these plebs because then we'll have a double spend problem. This is why we have an inflation rate, is because the government spends our money. It prints money, spends it. There's more of a case for taxation on states because states can't print money. That makes more sense, right? But the federal government can print money out of thin air anytime they want. Oh, just increase the debt ceiling. I mean, Jerome, you want to know something crazy? Jerome Powell, the thing that scares him the most, and like he stays in line a lot. But one thing where he was questioned by he was questioned in Capitol Hill recently and stuff like that by a congresswoman that pretty much what's going on and stuff like about the debt ceiling and stuff. And then he told me, he's like, you guys need to fucking raise the debt ceiling. I'm saying it in not nice words, but like, if you guys don't raise the fucking debt ceiling, we're not gonna be able to pay things for the government. And there's nothing we can print enough that's gonna save our asses off of this. I mean, it was the only time I've ever seen Jerome Powell a little scared and also like talking back like in a pretty masculine, deep voice to the senators and the House of Representatives, telling them like, yo, if y'all fuckers don't stop fucking around and don't increase the federal fund, increase the debt ceiling, we are going to have some big problems here in America. And shout out to Swerve the Dip, man. Normies can't have jobs. So I recently had on my YouTube channel, I had a Black Ice. He's a corporate recruiter for Silicon Valley and a lot of people in the tech space. He also hires people in the cryptocurrency space as well. And obviously, I mean, just me and him were talking a little bit in the background and stuff, and just kind of going over things. Obviously, there was a lot of overhiring in the space because of what happened in 2020, 2021 with the Android 19 virus. But regardless or not, that put the United, like, how do I say this? Like it wasn't that much of a crazy of overhiring and stuff like that. What's going on? So there's room to fire people off and stuff like that. But regardless or not, this is what the Fed wanted to destroy this stuff. But why these tech jobs matter so much is because this tech jobs are white collar jobs. They pay pretty well. They pay over $100,000 for most of them. Now they're on the Amazon side, you got a little shittier jobs. But these high paying jobs, these people pay the service workers, right? So these people end up getting, decide to get a new kitchen, decide to paint their house, decide to buy a house. Like it all trickles into the real estate market and a lot of other places and stuff. So, real estate's basically 30 to 40% of the U.S. economy. The tech sector, if the tech people aren't buying because they can't get jobs anymore and stuff like that hurts the sector already. The Federal Reserve increases the interest rate, so it costs more money to get into a 30-year fixed mortgage and stuff. I mean, I think right now, last I looked, it was like high 7s, 8% to get into a 30-year fixed mortgage in a house here in the United States. If they increase the interest rate increases that they originally planned to do within March, May, June, and July, that'll pretty much take us to 10% for a 30-year fixed mortgage. So we haven't even bottomed out yet on the real estate market. Like we will, the bottom of the real estate market, depending on if they decide to pause rates right here or not. If they pause rates in March, typically when the Federal Reserve pauses rates, we have a crash in the equities market. When there's a pause in the rate, whether interest rates are going up or down. So if they decide to pause in March and stuff, I think the best course of action personally would probably to increase the rate 25 basis points, not 50, but 25, in order to keep this thing going as they kind of like massage and probably secretly print in the background for the banking sector. Now, I don't personally honestly, none of us want to crash, but at some point they will pause the interest rate hike increases, and if it pauses sometime in June or July, then we'll get a very significant dump in the market. But we'll have to see what the Federal Reserve will end up doing with that. But that's just basically just giving you the FYI. It's gonna be really interesting to see if they decide, hey, we're gonna pause, we're gonna continue rates hikes in May and stuff. But but the way they kind of set themselves up and stuff, they have to keep increasing the rates in March and stuff. So it's kind of insane. Also, I think about 6 or 8 months ago was the first time that we had here in the United States a 75% basis increase. So there's kind of a thing where like whenever they do a dramatic increase, like a 75 basis point increase, like they did earlier in 2022, it takes 6 to 8 months for it to be really felt in the market. So we're starting to feel that 75 basis point increase in the market now today, and we had quite a few of them. So we got some rough months. We got a couple rough months in the equities market and stuff like that. I think crypto is going to be fine. And if since our banking sector is getting attacked a little bit right now, or quite a lot, we're probably going to have more people holding more of their capital in cryptos. Actually, the one important thing that just happened was CZ. Let me see if I can find the tweet, but CZ from Binance has $1 billion crypto fund in order to be like a backstop, in order to that was a backstop to kind of help crypto companies so they don't go belly up. Well, he decided recently to convert this $1 billion fund from stables over to Bitcoin and Ethereum, which is insane. So we're all, a bit of the pump could also be from CZ buying Bitcoin and Ethereum with $1 billion, with that $1 billion fund. And you have a lot of people who are holding out of USDC who finally got off their asses to fucking to fucking make some plays and stuff, right? A lot of people have been twiddling their thumb up their ass and not buying any crypto, and they missed out on a lot of gains here, if I'm just being honest and stuff. So it's interesting. So let me see if I can find that tweet for you guys. It's a really let me see if I can find that tweet for you guys. In the meantime, I'll give you guys a Pepe just for shits and giggles. Beautiful, beautiful, beautiful. So I have the tweet now. Now, for people who don't know, CZ is the CEO founder of Binance, the largest crypto exchange on the planet. And he recently just tweeted this out, I think yesterday. Yeah, yesterday. Given the changes in stablecoins and banks, Binance will convert the remaining $1 billion of industry recovery initiative funds. That's a mouthful. From BUSD, which is their own stablecoin, to native crypto, including Bitcoin, BNB, and Ethereum. So a little BNB there, yay. Some fund movements will occur on chain transparency. And the interesting thing about also buying a little bit of Binance coin as well is that Binance coin on their own network, right? Let me turn this off. A Binance coin on their own network, right? It acts a lot like Ethereum since it's its L1 token. If Binance token goes up, a lot of the little shitcoin pairs on PancakeSwap and on the Binance chain will also go up, which cause people to have more returns. So it's interesting. And if Bitcoin and Ethereum go up, you also get returns in the altcoin market. So it's really kind of cool sort of thing right there. So he hey, $1 billion. I mean, this does show like a lot of people follow what CZ does, right? This man has made few errors. The only thing I could think of that he could have done, but I get why he didn't do it, is he basically, for you guys who didn't know, he had Uniswap before Uniswap existed. Back in 2018, he was going to launch a DEX, a free range DEX and stuff like that, but he decided against it because he knew he would get scrutiny and he would be sued possibly by certain governments because of that DEX and stuff. So he decided not to. But CZ actually had the first actual Uniswap type DEX before Uniswap did. Just a little FYI on that and stuff. So interesting. Now, DCG, man, with the $8 Australian. Hey, DCG, do you think there's a mistrust and volatility in the traditional banking system will force a lot of people to pile into the next crypto bull? It will start. Yeah, it will start to. I mean, our market's we might break away for a couple of months and be the really shining light in gains, but at some point we will crash. I do expect when we do have that Fed pivot, whether it's now or later, the Fed pivot will take crypto down significantly in terms of like we might retouch again, the all-time low again for Bitcoin, but it's going to be a quick bounce. But I personally think that that's not going to happen until Bitcoin hits above $40,000, and then we get that crash down. Personally, so I think we have a nice couple months in the crypto space, and I think we take a little dip in the summer. After that, pretty much smooth sailing from there, and then past the summer, right, you start getting into the media storm in terms of you have a lot of people talking about the election, the Donald Trump versus whoever it's going to be, DeSantis or I don't know, whoever on the Democrat side, but basically you can't have any anti-crypto litigation during an actual run for the presidency and stuff like that. So basically, as soon as the presidential run really starts happening in September and stuff, when you start getting hints of it and stuff, basically there'll be no legislation against crypto that's really price positive. We have the Bitcoin halvening. Happening in late March, early April right now, which is another key thing. And if we get the pauses in the interest rates, like how I believe we will, whether now or in 3-4 months, that means we get the all-time low. We get the low in the real estate market at the end of Q1 to Q2. I'm leaning a little bit more to Q2 to Q3, but that means we get the real estate bottom in 24. We have the Bitcoin halvening in 24 as well. And we're off to the fucking races. And Trump NFTs all over America, baby. Sheesh.
You didn't have to cut me off. Think like it never happened, that we were nothing. I don't even need your love. You treat me like a stranger and I feel so loved. No, you didn't have to stoop so low. Have your friends collect your records and change your number. I guess that I don't need that though. Now you're just somebody that I used to know. Now you're just somebody that I used to know. Now you're just somebody that I used to know.
And yeah, he hasn't spent. CZ has spent the $1 billion. He hasn't yet. Yeah, he's moved a couple things around, but they're planning to and stuff. So so it hasn't happened yet. But some of it's happened, but not all of it and stuff. So he's gonna be. They're trying to make money basically. So we're in quite an interesting sort of time, man. If you guys like this content, please subscribe, hit the notification bell, and tomorrow I will be here at 8 p.m. Pacific Standard Time. I will be interviewing the guys from Famous and Fiat and stuff, and talking about the launch of their coin on Ethereum for eFiat, which is really cool. So insane. But that new Pepe hit different. That's for sure, man. I got the heavy bass one too, man. But it's how many years is crypto BS does it take to get out of mama's basement? Probably a year and a half. We're gonna be sitting really pretty, man. I mean, worst case scenario, we're pumping into 24, and then that's it. And then we go into a bear market again because the rest of the macro so shit. But if we get a regular cycle, we'll be pumping into 2025, baby. And that means the rest of 25 is dog shit. 26 is kind of a wash. 27, 28, 29, chef's kiss, baby. We're out here, man. I mean, this is going to be a cool decade, man. This is the roaring 20s. I've said this before on my stream many times. We're in the roaring 20s of cryptocurrency right now. Now, we're a new asset class. We're the fastest growing industry. All the money's coming here. And then our industry is money printers. Our industry is money printers. There's this whole thing where like they teach you like how, if I was a young guy, like what would I do to make money and stuff? They always tell you go into sales, right? Because the closer you are to the money, the more money you make. Well, I don't know how much closer you can get than the money printers, outside of making your own stable coin or coin, right? This is a beautiful industry to be a part of. There's a lot of volatility, but you definitely, man, it's the place to learn, man. And one thing we always help people out, man. Like there's this great group called the Citadel. It's down here in the description box below. It's $100 a month, and we were able to help out a lot of our students in this group right here. We have almost 400 people in the Citadel Access group right now. Every month that you're in the Citadel group, you get $50 off the next Crypto Mindset course, which is coming. You guys, we're starting to make plans to do the next Crypto Mindset course. It's been almost 5 months since the last one. It's happening again. Every month during the Citadel, you get $50 off the next Crypto Mindset course, and if you pay in crypto, you get 15% off on top of that. Damn, that's a lot. That's a good amount of savings right there. Every Monday, you get a dossier, you get a dossier of fundamental analysis, technical analysis, on-chain analytics, the chart setups for the top coins we're looking at, memes, top news events, as well as you get to talk to us and ask us questions. You can directly ask at Charlie or at Cultivate Crypto or at DCC or at Dollar Cost Crypto on there and ask us questions, and it's the best place to get in contact with us. We do private, unrecorded and recorded calls, flash webinars. There's opportunities to get into certain projects and stuff that we give access only to the Citadel and the Crypto Mindset courses as well. There's a lot of fight clubs. That's all I can say in there, but we got one that's coming up, you guys. Join up to the Citadel. I can't say more about that, but I got some shit cooking, man. Your boy out here cooking with gasoline. I rarely miss, baby. Huh. Baby, he's like, dossier, damn it, where's my thesaurus, baby? I'm sorry, I got binders full of women, baby. Shout out to all the OGs who got that reference. Binder full of women. But with that, you guys, thank you so much, man. And Hex is up. Just give you a little thing. Get some Hex and stuff. Hopefully, get some Hex. But since Hex is pumped so much, hopefully we get a little bit of a retrace. But it looks like we're going to continue pumping to about 10 cents to 12 cents, just FYI. I think a good coin to DCA into would be obviously get some Ethereum and stuff like that, but Hedron is really the one that hasn't moved in the Hex ecosystem. I think that's a decent one to buy right now. It's at 21. It hasn't moved against Hex at all. It's been a stable coin. It's probably a better stable coin than USDC at this point right now. Binder, Rip, that's right, man. Shout out to Mitt Romney right here. Binder's full of women, man. But man, it's going to be a wild amount of time, and I'm here for you guys. I will be back tomorrow at 8 p.m. Pacific Standard Time. That is, I think that's 11 Eastern. And we got the guys from Fiat and stuff. We have a cool coin we're going to talk about, and this is a coin that's going to be launching on the Pulse Chain ecosystem, as well as there's a coin launching on the Ethereum side. So thank you so much for joining me, and I'll catch you guys on the flip side, man. Peace.